Hi everyone. We might just wait a few more seconds just to give people a chance to log on. It's only just clicked over to midday, and then we'll start the presentation soon. Okay, so as I said, hello, welcome. Thank you for joining me today for the quarterly superannuation update. My name is Alexandra Plumb and I am a manager in the Superannuation Advisory Division here at Vincent's. I've got my contact details up on the screen at the moment, but I will share them again at the end of the session should you have any questions as we go along. So just a message that all information discussed today is factual and general in nature and doesn't take into account your personal circumstances. So today we'll be covering off on a number of changes and updates that have taken place within the superannuation space. We'll take a quick look at some upcoming key lodgement dates and payment deadlines. We'll run through the superannuation measures that have come into effect from 1 July 2021. We'll cover off on some new legislation that's recently been passed by Parliament, or should I say finally been passed. And lastly, we'll run through the updated contribution caps and other rates that are applicable for the 2021 and 2022 financial year. So firstly, let's run through some key lodgement dates and payment deadlines. Firstly, so on the 28th of July, I realise that one's been and gone, but that was the due date for the super guarantee payments for the June 2021 quarter. And it was also the due date for any transfer balance account reports for the June 2021 quarter for those self-managed super funds that needed to report on a quarterly basis. So just to refresh on transfer balance account reporting, or TBARs for short, and when trustees need to be lodging on a quarterly or on an annual basis. So for self-managed funds that have any members with a total superannuation balance of $1 million or more when they commenced their first retirement phase pension, they need to report all transfer balance account events within 28 days after the end of the quarter of that event occurring. And then for SMSFs that have members that have total superannuation balances of less than $1 million, those funds are only required to report transfer balance account events on an annual basis. And those annual reports are due at the same time as the fund's income tax return, which is in May. So then moving on to the 25th of August, so next week, not long, that is the due date for the lodgement of activity statements for the June 2021 quarter. And that's if those activity statements are prepared by a tax or a BAS agent. So then in a couple of months' time, on the 28th of October, so we're going to see the end of another quarter, we're going to have super guarantee payments due for the September 2021 quarter, and also TBAR reports for the September 2021 quarter, again, for those self-managed funds that are required to lodge on a quarterly basis. So at the end of October, on the 31st, that's the due date for lodgement and payment for any self-managed funds 2021 annual tax returns where the fund has currently got prior year tax returns outstanding, or the prior year return was lodged late. And then coming towards the end of this calendar year, on the 25th of November, that's the due date for lodgement of any activity statements. This is for the September 2021 quarter, and that's for those activity statements, again, that are prepared by a tax or a BAS agent. And lastly, on the 1st of December, this is the due date for the payment of income tax for any self-managed funds that are considered large or medium-sized entities. Funnily enough, the due date for payment is on the 1st of December, but the lodgement requirement for the tax return is not till January of 2022. It's a bit strange, that one. So moving on, there have been a number of new rules and caps that have taken effect from 1 July 2021. There's also a number of measures that are continuing on from the previous financial year. One of the continuing concessions from the previous financial year is the temporary reduction to the minimum pension drawdowns. So if you recall, this was introduced by the government back in March 2020 as a COVID relief measure to assist trustees and members to keep as much wealth as possible inside of super while COVID was wreaking havoc on our communities and the economy. So this concession was due to end at 30 June 2021. However, the government has announced that the temporary reduction would continue on until 30 June 2022. So this reduction allows members to only withdraw 50% of the normal minimum pension percentage that they would have had to take. So as we can see from the table, as an example, if you're aged under 65, you'd normally be required to withdraw 4% of your member balance as pension for the year. However, the reduction is only requiring you to withdraw 2% of your member balance instead. Now, of course, if members wish to take more than their minimum entitlement, they are still allowed to do that. Continuing on with the COVID theme, so as part of the flexible super bill that was passed at the end of June 2021, individuals who have received a COVID early release amount from their super fund, so that was the $10,000, now have the ability to recontribute up to the same amount back into their super fund. It's really important to note that this recontribution is not going to count towards your non-concessional contribution cap. And these contributions can be made at any time between 1 July 2021 and 30 June 2030. That seems like a long time away. And then also, as I mentioned, members can only contribute up to a maximum amount that was equal to the early release amount that they originally withdrew from the fund. This amount also can't be claimed as a personal tax deduction in your own tax return, so it has to be a non-concessional or an after-tax contribution. So for members wanting to take advantage of this recontribution, the ATO is requiring you to notify your chosen super fund in an approved form. And you need to do this either before or at the time that you're wanting to make this recontribution. Now, at the moment, the ATO are still ironing out some kinks in how that process will work, but they have stated that the approved form is going to be available for members to use by the 31st of August 2021, so in another week or so. So moving on to the super guarantee. From July 2021, the prescribed super guarantee rate has increased to 10%. So this is up from the previous 9.5% that we've been working with for a few years. The planned increase went ahead despite there being additional pressure on the government from some businesses and also the media to again look at pausing the increase. This call to pause the increase came about for a number of reasons, but predominantly it was due to the economic impacts that have been felt by small businesses because of COVID. But as we can see, the minimum super guarantee rate is continuing on its path to gradually increase to 12% by the end of the 2026 financial year. Onto a very important measure, and that is the indexation of the general transfer balance cap, which has increased from $1.6 million to $1.7 million from July 2021. So the indexation of this cap now means that there won't be a single cap that applies to all individuals, as what we've previously seen since the cap came into effect in July 17, where we've just had $1.6 million for all. So every individual is going to have their own personal transfer balance cap, and it's going to be somewhere between 1.6 million and 1.7 million, and it all depends on their circumstances. So how do we work out what your personal transfer balance cap is going to be? Firstly, if you start a retirement phase pension for the first time on or after 1 July 2021, then your personal transfer balance cap is going to be 1.7 million. That one's easy, fairly straightforward. You're new to the pension game. However, if you had a transfer balance account that existed before 1 July 2021, so basically it means that you had a retirement phase pension that existed prior to this date, then your personal transfer balance cap will either be 1.6 million or somewhere between the 1.6 million and the $1.7 million. So for your cap to remain at the 1.6 million, so that is it won't receive any indexation, you would have had to have a transfer balance at any time between July 17 and 30 June 2021 that was $1.6 million or more. Otherwise, if your transfer balance didn't exceed 1.6 million at any time during that period, then your personal cap will be an apportioned amount somewhere between 1.6 million and 1.7 million. And this amount is based on the highest ever balance that you had in your transfer balance account between July 17 and June 2021. So I talked a lot about transfer balance accounts here. What are they again? Transfer balance accounts are a record of the events that count towards your personal transfer balance cap. So the most common events that we would see going through the account is when an individual starts a retirement phase pension, or when they choose to stop all or part of that pension or pensions in that account. So if you thought all of that was a little bit tricky to follow, that's okay. The good news is that the ATO will be calculating the individual's personal transfer balance cap. Trustees don't have to do it themselves. These ATO calculations will be based on information that has already been reported in TBARs, so the transfer balance account reports, and also in the super fund's annual income tax returns. So this is why it's extremely important that self-managed fund trustees ensure that their fund is up to date on all TBAR and tax return lodgements, or else we're going to risk having that the ATO will calculate an incorrect personal transfer balance for the fund's members. So from 1 July 2021, you will be able to view, or you already can now then, able to view your personal transfer balance cap via the ATO online platforms. So the last measure that I'd like to bring to your attention is the new amended accounting standard that's been released by the Australian Accounting Standards Board, AASB 2020-2. So like all the other measures, it applies from 1 July 2021. This new accounting standards requires certain entities, and this includes self-managed super funds, to prepare Tier 2 general purpose financial statements as a minimum reporting requirement if the entity's trust deed requires that the preparation of financial statements to be in accordance with the Australian accounting standards. So prior to this coming into effect, self-managed funds were only required to prepare special purpose financial statements. Now, the difference between a general purpose and a special purpose financial statement is that general purpose financial statements need to be prepared and presented in a very specific format. So in accordance with the Australian accounting standards. This format is far more stringent and regulated in comparison to what is required when you're preparing special purpose financial statements. So again, it's very important that the SMSF trustees are reviewing their fund's current deed for a clause that requires the fund to prepare financial statements in accordance with the Australian accounting standards. If your SMSF deed does include this clause, then your fund will be required to comply with AASB 2020-2. Now, thankfully, most SMSF trustees refer to financial statements as needing to be prepared in accordance with superannuation laws as opposed to the accounting standards. So the introduction of this standard is likely not going to be an issue for majority of self-managed funds. But if you're an SMSF trustee and you find that this is an issue in your current deed, I suggest that you look at having the trust deed updated to remove the clause. This is something that Vincent's can help with, the process of reviewing the deed and also helping you organise to get that deed updated as well. Moving on now from recent super measures that have taken effect, and let's look at some superannuation legislation that's recently been passed by Parliament. So the first of these laws, which received royal assent in June 2021, allows for the increase of membership in both self-managed super funds and also small APRA funds. From 1 July 2021, funds can now have up to 6 members. So previously it was only 4. The topic of increased membership in self-managed funds and small APRA funds has been debated for a number of years now, but the fact that this increase has been legislated has been welcomed by many. So if you are considering expanding your fund's membership, please consider whether your fund's trust deed allows for it. Also have a think about the current structure of the fund and its reporting requirements. Trustees need to keep in mind that there are some state and territory laws that actually restrict the number of trustees that a trust can have to be less than 6 people. Now, a self-managed fund is a type of trust, so it's important that you seek some professional advice to help you understand if your self-managed fund is impacted by these restrictions. But one way to avoid the potential restrictions of these laws is if your SMSF has a corporate trustee, so that counts as just one trustee, even though you might have each member is a director of that company. So the second law to receive royal assent, also in June 2021, is the age that allows members to access the bring forward rule for non-concessional contributions. This is increased from 65 up to 67. This age increase can be applied retrospectively to non-concessional contributions that were made on or after 1 July 2020. So a reminder that individuals already have the ability to make non-concessional or after-tax contributions into super up to the age of 67 without needing to meet the work test. So this new law that's come in is kind of just bringing the bring forward rule up to be in line with this rule as well. So depending on your total superannuation balance, the bring forward rule allows you to contribute up to 3 years worth of non-concessional contributions in 1 year. Once the bring forward rule is triggered, just remember that you're not able to make any further non-concessional contributions for the following 2 financial years after that. So individuals who are age 65 and 66 who are not previously able to use the bring forward rule, even if they had met the work test, are now able to bring forward their non-concessional contribution cap. So that's enough about new legislation. Let's move on to what's new in the world of super contributions. So firstly, let's take a look at concessional contributions. And the big news here is that the annual cap has increased from $25,000 to $27,500 for all individuals, regardless of your age. What does remain unchanged, though, from previous years is that members aged 67 or older are still required to meet the work test in order to make the contributions, and you also still need to lodge a Section 290-170 intent to claim notice with your fund if you intend to claim a personal tax deduction for the contribution that was made. Additionally, if you accidentally exceed the concessional contributions cap, the excess amount is still included in your personal assessable income and is taxed at your marginal rate. What is new in the space of excess contributions, though, is that individuals who have accidentally ended up with an excess concessional contribution on or after 1 July 2021, they will no longer be liable to pay excess concessional contribution charge. So this charge was essentially an additional penalty that was imposed for exceeding the cap. So that's good news. Also, a reminder that eligible individuals are still able to make additional catch-up concessional contributions from prior year caps. So to be eligible to make catch-up concessional contributions, your total superannuation balance must have been less than $500,000 on the 30th of June of the previous financial year. So the unused portion of the contribution caps are available for a maximum of 5 years, and after that they're going to expire. So for the 2022 financial year, eligible members are able to utilise their unused concessional contribution cap for the last 3 financial years. So over to non-concessional contributions now. The annual non-concessional contribution cap has increased to $110,000 from July 2021. As I mentioned earlier, the amount of non-concessional contributions that you can contribute into super depends on your total superannuation balance at 30 June of the previous financial year. So to clarify, your total superannuation balance is essentially the total of all monies that you have in superannuation. So this means if you have multiple member accounts across multiple super funds, then your total super balance will be the sum of all of these balances and accounts. So if your total super balance is greater than or equal to the general transfer balance cap, so the 1.7 million, you won't be able to make any non-concessional contributions into super. But as an extension of what non-concessional contributions can be made, we also need to consider the impacts that your total superannuation balance has on your ability to utilise the bring forward rule. So from what we can see in the graphic here, and as I've mentioned previously, if your total super balance is over 1.7 million, then you're not able to make any non-concessional contributions. However, in a rather unusual set of numbers used, if your total super balance is between 1.59 million and 1.7 million, then you're able to contribute up to $110,000 worth of non-concessionals, so the equivalent to 1 year of contributions. If it's between 1.48 million and 1.59 million, then you can contribute up to 220,000, or the equivalent of 2 years worth of non-concessional contribution caps. And then finally, if your total super balance is less than $1.48 million, you're able to fully utilise the bring forward rule and contribute up to $330,000 worth of non-concessional contributions. So to conclude the discussion around contributions, I just want to cover off on a couple of the other caps that are still available. Firstly, super co-contributions are available to low or middle income earners that make after-tax contributions into super. So if eligible, the government will contribute up to a maximum of $500. Your entitlement depends on your income and also how much you contributed into super. And again, like everything else, your eligibility also hinges on your total superannuation balance. It needs to be under the transfer balance cap in order to qualify for this. And then lastly, in terms of eligibility to receive the co-contribution, your total income must be less than the higher income threshold. So for 2022, this higher income threshold is $56,112. So then the low income super tax offset is another government payment, again, up to a maximum of $500. And this is designed to help low income earners save for retirement. So individuals with an adjusted taxable income of under $37,000 would be eligible to receive a refund into their super fund of the tax paid on their eligible concessional contributions. And then finally, don't forget, downsizer contributions are still available. A reminder, to be eligible for these contributions, you need to be age 65 or over at the time of making the contribution. The amount that you're contributing needs to come from proceeds from selling your home, and your home needs to be owned by you or your spouse for 10 years or more. The property needs to be your main residence. You need to make the contribution within 90 days of receiving the proceeds of sale, and you also can't have made a downsizer contribution previously from the sale of another home. So in closing today, I'll just run through some other changes for other rates and thresholds applicable to super. So circling back to the super guarantee, the maximum contribution base for the 2022 financial year has increased to $58,920 per quarter. So this means that employers are not required to pay super guarantee on amounts above this quarterly threshold. The CGT cap has increased to 1.615 million. This is a lifetime cap, and it's available to you if you wish to make contributions that have arisen from a capital gains event, and it also has met the requirements of the small business retirement exemption or the small business 15-year exemption. The low rate cap has also increased to 225,000. This is another lifetime cap, and it allows individuals aged between their preservation age and 59 to treat lump sum benefits withdrawn from their super as being tax-free up to the cap amount. So any benefits withdrawn that exceed the cap amount, they're taxed at 15%. And then lastly, Division 293 threshold, that remains unchanged at $250,000. So if your personal taxable income exceeds this $250,000 threshold and you've made concessional contributions into super, you will be required to pay an additional 15% tax on those contributions, and that tax will be levied in your own name. You do have the option to elect for your super fund to pay that tax on your behalf if necessary. And then for those with a related party limited recourse borrowing arrangement in their self-managed fund, just to note that the ATO's safe harbour interest rates are remaining the same for the 2022 financial year. So that's 5.1% for arrangements used to acquire real property and 7.1% for arrangements used to acquire listed securities. And then finally, just always an important reminder, your date of birth does dictate when you have met or when you will meet your preservation age. So why is your preservation age important? It's going to count towards when you will be entitled to access your superannuation benefits. So for individuals that have met their preservation age and they have also satisfied a condition of release, they will be the two requirements that will allow you to access your super benefits if you need to. Just a refresher that a condition of release, as an example, that could be retiring from your form of employment, if you've been diagnosed with a terminal illness, or if you've become permanently incapacitated, just to name a few. So that concludes the quarterly superannuation update today. If you have any questions about the content covered in today's session or about superannuation generally, please don't hesitate to get in contact with me. My details are back up on the screen there. We've also made available, and that should be available for you now or very soon, for anyone that's tuned in today, a reference guide that lists all applicable super rates and thresholds for the current financial year. I know it's a guide that I tend to refer to a lot as just a quick reference tool, so I would definitely recommend grabbing a copy of that if you can. So thank you again for joining me today, and enjoy the rest of your day.